We start the show with the US, which has an economy that may or may not be in recession, depending on who you talk to. Let's take a look at the latest numbers released by the Commerce Department this week. Now, data shows US GDP shrank just under 1% in the 3 months to June compared to the same quarter last year. That follows a larger contraction of 1.6% in the first 3 months of the year. Most economic literature will tell you that 2 consecutive quarters of decline means a recession, technically. But not so fast, says the White House, which has a broader set of criteria. Washington insists that because businesses continue to add jobs, household incomes are still rising and exports are growing, the world's largest economy remains healthy.
Most economists and most Americans have a similar definition of recession. Substantial job losses and mass layoffs, businesses shutting down, private sector activities slowing considerably, family budgets under immense strain, in sum, a broad-based weakening of our economy. That is not what we're seeing right now when you look at the economy.
Our job market remains historically strong. Now, there's no doubt we expect growth to be slower than last year and for the rapid clip we had. But that's consistent with the transition to a stable, steady growth and lower inflation.
And that brings us to inflation, perhaps the biggest crisis in the US right now. Consumer prices there are rising at their fastest pace in 40 years. That's tied mainly to the crisis in Ukraine and what that's done to the cost of food and fuel. Officials have met historic price hikes with an equally historic response. The US Federal Reserve has raised interest rates by a total of 1.5 percentage points since June in its most aggressive inflation-busting program in decades.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all.
Well, the state of the US economy will have broad implications for the rest of the world. That's according to the IMF's updated World Economic Outlook released this week. It slashed its forecast for global growth, citing the conflict between Russia and Ukraine. The lender's also warning that as central banks like the US Fed raise interest rates, financing will get more expensive. That's bad news for companies and nations that are already struggling to cope with massive amounts of debt.
The outlook has darkened significantly since April. The world may soon be teetering on the edge of a global recession, only 2 years after the last one. Multilateral cooperation will be key in many areas, from climate transition and pandemic preparedness to food security and debt distress. Amid great challenge and strife, strengthening cooperation remains the best way to improve economic prospects for all and mitigate the risk of geoeconomic fragmentation.
Well, let's get more on this now with Mickey Levy in New York. He's chief economist for the US and Asia at Berenberg Capital Markets. Great to have you back with us, Mickey. Now, almost every economist would agree that 2 straight quarters of economic contraction equals recession. But despite that, the Biden administration says that the US isn't in one. What are your thoughts? Is the US in recession right now?
It's certainly tilting toward one. Now, keep in mind, if you look underneath the GDP numbers that declined, you had several percentage points subtracted by inventory slowdown. And so basically what you see is in the first half of the year, employment rose, consumption rose, business investment rose in the first quarter. But the second quarter, what you saw is a significant slowdown in consumption. Housing fell, business investment fell. So we're clearly teetering on, recession-type conditions. And you see this in the corporate earnings reports for the second quarter, where it varies across industry, but a number of businesses reported weaker than expected product demand. They're putting freezes on hiring. Once again, the housing data are weak. Businesses will be cutting back capital spending. So, look, the Biden administration is trying to paint a rosy picture on things, but we really are in the U.S. experiencing recessionary type conditions. And this is what you would expect from just the very high inflation that's cutting into real disposable income, and now the Fed raising rates, which increases the cost of borrowing. So it all adds up to, recession-type conditions right now, definitely.
Yes, just to rehash those economic realities on the ground there, as you say, US unemployment rate is at a near half-century low. Wages are also rising, albeit not as fast as inflation. But as you say, consumer confidence has all but collapsed right now. We're also seeing inflation causing real hardships, even for people with jobs. And as you say, the property sector in some areas of the US is also in quite a significant downturn. It's not looking rosy on the ground, but how much longer do you expect those conditions to last?
That's a great question, and I think it hinges critically on inflation. And what we're going to see over the next couple of months is a decline in headline inflation as gasoline and energy prices come down a bit. But food prices are remaining high. As you noted, wage pressures are mounting, and business costs of production are going up, and they're going to continue to push on higher prices. So I would expect, most goods and services, you're going to see upward pressure on prices, and that is going to continue to bite into real disposable income. So I think we're looking at this situation where, at least through year end into 2023, recessionary type conditions as businesses respond to the higher inflation and the slower product demand. And what that means is businesses are going to start slowing employment. You can look for weaker labor markets, a drift up in the unemployment rate, and all this is going to compound the problem. So this is going to last. It's not going to be a deep recession like 2020 or 2008 or 9, but it'll be shallow but definite recession-type conditions.
Now, the US Federal Reserve, along with the Treasury Secretary Janet Yellen, are trying to promote this idea that they are able to cool the economy by raising interest rates without slamming on the brakes and putting it into reverse. Is that possible, or is a recession simply the bitter pill that the US must swallow in order to tame inflation?
Well, you're asking the great question here, because historically, when inflation has risen, the Federal Reserve has had to raise the federal funds rate above inflation in order to slow the economy enough to reduce inflation. This time around, while the Fed has raised rates 75 basis points in each of the last two meetings, the federal funds rate target now is 2.25 to 2.5, which is way, way, way below inflation. And so Federal Reserve Chair Powell is basically hoping that product demand slows and inflation comes down. But, the definite risk here is that inflation stays higher than the Fed's rather sanguine forecasts, and the Fed will have to hike rates further. And so we're in the middle of this, or even the early stages, and the story's not over. So the rate of inflation holds the key, and my hunch is the Fed's going to have to, raise rates more now than the market is expecting.
Okay, it really is a waiting game, isn't it? Mickey Levy from Berenberg Capital Markets, a pleasure as always. Thank you.
Thank you.